Welcome to Investing by the Books, a podcast by Redeye. I'm your host, Eddie Palmian, and next to me is my friend Niklas Sävås. How are you doing today?
I'm really good today. Really excited to speak with one of my heroes. But I think you are maybe in a bit better mood than me.
Slightly, maybe. It's my birthday, but I'm sure it feels like yours as well. And as you say, today we will talk with Michael Mauboussin, Head of Consilient Research on Counterpoint Global at Morgan Stanley Investment Management. And he has such a vast experience, I don't even know where to begin. He has been Director of Research at Blue Mountain Capital Management and Head of Global Financial Strategies at Credit Suisse. Since 1993, he has been an adjunct professor of finance at Columbia Business School, teaching the legendary security analysis course. What else has he done?
So Michael has been very influential with the Santa Fe Institute, and he's also a thought leader on decision making, the role of complexity in markets, as well as most topics related to investing. He's the author of countless articles and the books More Than You Know, Think Twice, The Success Equation, and the one we will discuss today, Expectations Investing, written with Alfred Rappaport.
So why have we chosen Expectations Investing?
I mean, this is one of my all-time favorite books that has influenced me a lot in my investing career. I think it's very well written and easy to read. And one part of the book, what I think is really good, is that the authors end each chapter with a summary of all the essential ideas. And with Expectations Investing, as with all the other work I read from Michael, I always feel a bit smarter than before, but also a bit overwhelmed, as it's always a reminder of the work needed to become a great investor. So Expectations Investing has made me improve and also made my process to find new investment ideas more efficient. So Eddie, can you tell us a little bit about the idea of Expectations Investing?
Definitely. As you mentioned, it introduces a new way to think about a concept. And in this case, it focuses on the art of stock valuation. And we know that there are so many different ways to do that. And some use screeners to find undervalued companies. Others begin with a deep study of the industry, the competitive dynamics, or company specifics. And the Expectations Investing inverts the traditional discounted cash flow method. And instead, you start with the current stock price to analyze what expectations are priced in terms of growth rates, margins, as well as investment efficiencies. And depending on if those expectations seem reasonable or not, one can decide to do the necessary deep research on the company. And we'll definitely get into the process during the conversation. How does the book fit with our quality rating here at Redeye?
I think it fits within the toolbox that you need to have as an analyst and investor in order to evaluate, for example, a competitive situation of a company, where the authors take up Porter's 5 Forces and Clayton Christensen's framework for disruptive innovations as examples. But most of all, I would say I think it's a framework for how to make better investment decisions and become more efficient in your process.
The first edition of Expectations Investing was published in 2001, and an updated version has now been released by the same authors 20 years later. To us, this is a must-read for every sophisticated or aspiring investor, and it is a true honor to have one of the authors on the show. Here comes our conversation with Michael Mauboussin. So hello, Michael, and welcome to Investing by the Books podcast.
Thanks for having me. I'm really pleased to be with you today.
It's great to have you on, and we're really grateful to have you here and for everything you are doing for the investor community through your articles, books, and teaching. And we're curious, what is your motivation to educate?
Well, it's interesting. It's more selfish than I would like to admit, probably. I find that for me, the mode that works most effectively, and almost like the way I think about how my professional career is most fulfilled, is a combination of input and output. And input really is learning. So I'm curious about a lot of things, and I find myself very gratified when I can go out and learn about new things. But learning about it is only half the equation. At least for me, I feel much more satisfied when I can ultimately output it, and that primarily is a function of writing and then ultimately teaching. And I think that the process of writing and teaching ultimately helps consolidate that knowledge and understanding in my own mind. So I don't really understand a particular topic or thesis until I believe that I can explain it to others or write it about it in a way that's fairly clear. So, as I said, I wish I could say it's some sort of big, trying to help the world. So it really is something. It's almost like an output of the kinds of the way I like to operate in general professionally. So,
we're really, really thankful for that. Also, I mean, even though it's helping you, I think it helps others even more. So. And the latest example was, of course, the updated version of Expectations Investing. And the subtitle of the book is Reading Stock Prices for Better Returns. Can you explain what you mean by reading stock prices?
Yeah, sure. And just a little bit of background on this is that I read Al Rappaport's book, my co-author's book, which was published in 1986. I read that in the late 1980s, and chapter 7 was called Stock Market Signals to Managers. And it was an extraordinary lesson for me and just made things very clear. And the argument he made there was, as an executive, it's really important to understand what your stock price reflects about the future financial performance of your company. And that is in terms of matching expectations and capital allocation decisions and so forth. So what reading stock prices means is typically investors try to think about what values should be, and then they compare those values to the prevailing price. And that sort of seems to be the default way of people doing things. So they'll say, oh, this business is trading, has earnings or cash flows of X, and it should be traded Y multiple, and that gives me a value, and then I compare that to the price. As you've gathered, expectations investing goes backwards and says, we're going to start with the only thing we know in this equation for sure, and that's the price. And then we're going to ask a very fundamental question. What has to happen for this stock price to make sense, right? To equal this current stock price. And then we're going to introduce, analysis to figure out whether those sets of expectations are too high or too low. So it's reversing essentially the process and starting with price rather than trying to figure out value. And I think the metaphor that's most apt for this is actually handicapping, horse racing. So when you think about making money as a handicapper, there are really two very discrete aspects to it. The first is understanding how fast a particular horse is going to run in a particular race. And there again, you'd be studying fundamentals, how the horse has done before, the current conditions for the race today, the distance, and so on and so forth. The second thing, though, is what the odds are on the tote board, right? What is the probability this horse is going to do well? And it's really the discrepancies or mispricings between the odds and the horse's likely performance. That's the key thing that you're looking for, right? So you're not looking for who's going to win the race, which horse is going to win the race. You're looking for misprice odds. And it's the same basic concept here for investing. So we're saying the stock price itself is essentially telling you what is priced in, what the odds are, the likelihood of success. And then your task is going to be, can this company meet or exceed those expectations, or will they fall short?
So the first edition of the book is now 20 years old, and you write that changes in the world make the expectations investing process more useful than ever. So why is that?
Well, I think that there are a couple themes that have threaded throughout this that have become even more important today. One is that the book emphasizes early on, for first edition and second edition, that it's very important to focus on cash flows versus accounting earnings. And I think if anything, and there's great work by Baruch Lev at New York University, he wrote a wonderful book called The End of Accounting a few years ago, documenting this. Earnings have become less relevant than they were before. So I think that this continued focus, or perhaps a renewed focus on cash flow, becomes very relevant. The second thing is we wrote a chapter which now appears to be even more important than it was at the time. And it was called Across the Economic Landscape. That's chapter 9, where we talked about a very simple taxonomy of types of businesses. We talked about physical businesses, where the source of competitive advantage are physical assets. service businesses where people are at the core of competitive advantage, but they deliver their service one-on-one. So you think about accountants or lawyers or that type of thing. And then knowledge businesses where, again, people are at the core, but people create content once and replicate it over and over. So we talked about the characteristics of those types of different businesses in terms of scalability and obsolescence and so on and so forth. And that was, of course, relevant in 2001, but of course, I think even more relevant today in 2021 as we think about the world today and the market rise of intangibles. As an interesting sort of datum, these are now data for the US. So just to put it, and these trends are true essentially globally, but for the US, just to put a point on that our estimate is that intangible investment and CapEx were essentially equal to one another in the year 2001. So if you think about them as a race, they're starting in exactly the same spot. The most recent number we have is 2020, although we can sort of project out now pretty comfortably for 2021. And it looks like intangible investments will be double those of tangible investments. So you could call it roughly in one investor generation, we've seen a doubling of the relative relevance of intangibles versus tangibles. So that's a second one. And maybe the third one is we have a chapter called Beyond Discounted Cash Flow. We talk a little bit about the concept of real options. And real options, again, have always been important. But with the rise of uncertainty, especially in the digitalization of some parts of the economy, I think that options themselves are more important than ever. And so that might be another thing that would make the concept of the processes and tools we discuss in expectations investing more useful than ever.
Yeah, we will dig in deeper into all those areas in the discussion. But let's begin a bit with the art of valuing stocks. I think you have touched upon this already, but what do you see as the main problems with how most investors value stocks today?
The broad idea is that people tend to use heuristics, right? Heuristic is a fancy word for a rule of thumb, and the rule of thumb that we all tend to default to are multiples, right? So we use, if you do surveys of professional investors, two multiples in particular appear to be by far the most popular, and that is the price earnings multiple and the enterprise value to EBITDA multiple. EBITDA being earnings before interest, taxes, depreciation, and amortization. So that's the EBITDA piece of that equation. And there's nothing wrong with multiples, by the way, just to be clear. But the problem is multiples embed lots of different economic assumptions that investors sometimes are unaware of. So for instance, a multiple will embed a growth rate, an assumption about return on invested capital that may be very difficult for an investor to really understand or unpack. And what we would argue is it's much more valuable to make bare those sets of assumptions so that you can have a healthy and thoughtful and informed debate about the company's financial performance versus burying those things in a multiple. So to me, that's still the biggest issue. And perhaps, we wrote a piece about price earnings multiples, and I think we subtitled it something like bridging multiples to economic reality, and I think that's the main concept I want to emphasize is not that multiples in and of themselves are bad. It's just you need to understand what the assumptions are that would justify various multiples. So as I say to my students, you must earn the right to use a multiple. And that means to earn the right means that you've demonstrated that you've understood the underlying assumptions about value. Now, the other thing I'll just say, which we talk about very early on in the book, is the limitations to earnings themselves. And I'll just say something that you guys know very well, which is growth in and of itself doesn't tell you anything about value creation. The key to value creation is generating attractive returns on investment. So saying this very differently, a company can grow quite rapidly, but if it's earning exactly its cost of capital, it's effectively on an economic treadmill, right? It's moving its feet faster, but it's not going anywhere. So it becomes very paramount for investors to understand first and foremost the underlying economics of the business and return promised, the returns the business promises. And then second, we layer in growth as essentially what ends up being an amplifier. Now, if you're earning your cost of capital, doesn't amplify anything because there's nothing to do, but high return on capital businesses, growth amplifies value creation, and low return on capital. If you're earning below your cost of capital, the more you grow, the more wealth you destroy, right? So growth ends up being this amplifier rather than a thing in and of itself. And I think that many investors and truly many executives think about growth first and foremost when it really should be the secondary and perhaps even the tertiary consideration in total value creation.
I fully agree that it's something that you hear from many investors that this company is growing this much, so it must be valuable. But as you say, it depends. And another thing I quite often hear is that investors state that they have an edge by taking a long-term approach. So they say maybe that they look 3 to 5 years ahead, while the market takes a 1 to 2 year approach or something like that. I'm curious to know what's your take on that.
Well, there's sort of two aspects. In one way, I think it's not right. In another way, I think it can be right, or I'm sympathetic to it. So what is the way in which it's not right? Is that if you just do the basics of mathematics, and that's any sort of discounted cash flow model, and just apply it to any particular company, you'll find that pretty quickly you need to recognize and pay. You are paying for cash flows many more years into the future than just 2 years, right? You're paying for cash flows many years into the future. That's just a mathematical reality. So that in that sense, the market is paying for long-term cash flows. And by the way, that's not new news. That's been true for a long time. So people often get confused. We have a line in the book where we say investors make short-term bets on what are long-term outcomes. And I think that people can't lose sight of the long-term outcomes. Now, where am I more sympathetic with that argument, or where I think that argument holds some water, is this idea of extrapolation, right? Which is to say that what tends to happen is, if you talk about inefficiencies in the market, one of the main inefficiencies is deemed to be behavioral. And of the behavioral work, it's over extrapolation, right? Which is we take what's currently happened, we anticipate that will continue to be for the foreseeable future. So we over extrapolate what we currently see. And of course, over extrapolation would be for positive things and for negative things. And for many years, by the way, it was essentially the behavioral explanation for the value factor, right? So people would say, oh, growth companies are going to continue to grow, and we're over extrapolate that growth rate, and they're inevitably going to stumble and disappoint us. And as a consequence, they'll deliver substandard returns relative to the expectations. And by contrast, value stocks are these companies that are sort of not growing very much, and they're stumbling along, but people think they're going to be bad forever, and they actually regain their footing, do a little bit better. So they revise expectations up, and those stocks do better, right? So that to me is when you say, well, taking a longer term horizon, to me, if I want to paint that as a positive picture, it would be something like we are thinking about what the world will look like in 3 to 5 years. And we're looking over this issue of potential over extrapolation, right? And we're thinking about the longer term horizon. And, I think we start the strategy chapter with something along the lines of saying, the surest way to anticipate revisions and expectations is to understand changes in the competitive positioning of the business. And to that degree, that statement of looking out longer would be a very solid way to think about that. So a long-winded answer to your question, in some ways, mathematically, it's not a really correct thing. But when you're thinking about expectations and strategy and positioning and over extrapolation, that would be, I think, a pretty reasonable way to think about it.
So if we go into the tools of expectations investing that you are highlighting in the book, and you also have a great website with tools and lots of information. Your process consists of 3 steps. The first is to estimate what expectations are priced in, or what you call the price-implied expectations. How do one do that?
So they're really, as we pointed out, the key is to start with the current stock price. So that's the one thing that we know. And then we attempt to gather information about the key value drivers of the business. And whereas the consensus is probably a good starting point, I will absolutely quickly concede that there's some art to this. It's not pure science, but you want to get a sense of what the market believes are longer term growth rates, longer term margins, capital intensity, so how much working capital, fixed capital will be required, some estimate of the cost of capital, and so forth. And then you're going to say, when I put these into the model, how many years of value creating growth is reflected in today's stock price, right? So essentially, when you're trying to solve for price, there are three variables that you need, and obviously we have to hold some things constant. There's a cash flow stream, which is going to be determined by sales and margins and capital intensity. There's a discount rate, which is going to be your estimate of the cost of capital. I think we can talk more about that in just a moment. And then there's going to be an explicit forecast period. And the forecast period in our context has a very specific economic significance. The forecast period says, how long will this company be able to find value creating investments? And the premise is that value creating investments for any particular company are going to be finite for a couple of reasons. One is market saturation, right? Eventually, every market essentially gets saturated. And second is because of competition. So if you're doing something that's particularly lucrative, it's often going to be the case that other people are going to try to participate or compete with you and drive your profitability down. Now, we know that, of course, some businesses have been able to sustain very high returns in sort of businesses for a very long time. So this is not hard and fast. But the basic concept of, most companies have a finite period of an ability to invest incrementally at above the cost of capital. So that's the basic framework. And as you point out on expectationinvesting.com, there's a set of online tutorials, and tutorial 8 actually walks you through this step by step. And importantly, there is a downloadable Excel spreadsheet. So anybody that's motivated can click down on the spreadsheet. Now, the spreadsheet that we actually populate matches with a case study in the book, which is on Domino's Pizza. But of course, so it's meant for you to map to what we've done, so you can see that clearly. But of course, that it's easy to take off script. If you're working on a different company, you can of course put in your own inputs, and the same framework should hold up reasonably effectively. So that's step one. And the other thing I'll just say about step one is to me, it's very important to have no preconceived notions if you can, right? Which is to say, I'm not going to make a judgment as to whether the expectations are too high or too low. I just want to understand what the world thinks, right? And so to me, the metaphor would be, where is the bar set for the high jumper, right? I'm not going to worry about how high the high jumper can jump just yet. I just want to know, is the bar set at 5 feet or 7 feet or 10 feet. And that's the first place for me to start, is to understand what is the task I'm up against here. Right. And again, there's plenty of art in this, but it's very much of a doable task, especially with some of the tools that we put at your fingertips.
And you definitely have great visualizations also in the book that we of course urge everyone to buy the book and complement with the website that you mentioned. So
thank you.
It's so good when you can see it mapped up like that. But one challenge is that prices and expectations, they change constantly. So how often or when should investors revisit the expectations?
Yeah, the guidance would be something like, one of two things happen, and they, by the way, often happen simultaneously. If there's been a market change in the price, so the stock has gone up or down a lot, it's an important thing for you to revisit expectations. And secondly, has there been new value relevant information? So that could be a strategic change, it could be a merger or acquisition, or some sort of a spinoff, or some other change that would be material. So those are the things I think would prompt kind of a full revisit of what you're doing. Now, we haven't gone through all the steps yet, but just to be clear, if at the end of the day this triggers, for example, the purchase of a particular stock, what we're trying to do is operate with a little bit of margin of safety, right? So in other words, we're not working with such degree of granularity and fineness that you have to it's a super well calibrated thing. There should be plenty of room to move these things around a fair bit. So, the answer is big price moves, big informational changes might prompt you to go back and revisit what you're doing. And, this is, we just finished sort of the main earnings part of the season. This is a time where companies come out and, most of them obviously sort of report along the lines of what people anticipate, but from time to time you get companies that do much better or much worse. And that would be a clear prompt to go back and say, okay, should I be changing the trajectories of what I think?
That's I think many people struggle a bit with. If you have your stock going down 20%, then you just buy more without maybe doing the proper analysis, as you say,
or sell it.
Yeah. One thing I wanted to discuss a bit more. Most of the concepts in the book was really either eye-opening or confirmations of what I thought. One thing that was that stood out a bit that I want to discuss was beta. So here at Redeye, I work as an equity analyst, and we have a proprietary rating model where we answer over 100 questions about the management and the board, the business model, competitive situation, as well as the financials, which in the end determines our equity risk premium. So I wanted to know your view on that.
Yeah, I think that's all fine. And let me I guess I'll make a couple comments. One is just to be clear, and you're right. I mean, you detected this because I think we were both keen to skirt we ended up putting in the end notes, if you actually read the actual end notes on this, but we wanted to skirt the controversy on this because it's a little bit of a diversion, right? But let's just be very clear that the cost of capital, which usually has two key components, the cost of debt and the cost of equity, is a representation of the opportunity cost of capital providers, right? So let's not lose sight of what we're trying to estimate here. Now, the cost of debt tends to be quite explicit, so we can identify that pretty readily, and I think we can agree on that pretty readily. And by the way, that alone is pretty interesting and useful for the fact that we can, usually credit spreads for particular companies will give you some indication about the equity return prospects and so forth. To your point, just to be like a little bit of finance stuff on this, look, there's a market risk premium and you multiply beta times that. So just for everybody to be on the same page, the idea is beta is a measure of how more volatile your company is relative to the market, right? So, or some sort of appropriate benchmark. But we'll say the market. And so if your beta is 1, that means you're just as volatile as the market. The market goes up 1%, you'll go up 1%, down 1%, so forth. Right? If your beta is above 1, that means you're more volatile than that of the market. And then if your beta below 1 means you're less volatile. Right. So I think the kinds of things you guys are doing with people and businesses and financials, that all makes a lot of sense. Now, the other thing I'll just say from a finance point of view is you can think about beta from the point of view of the company, and it starts with asset beta and then it adds financial leverage, right? So asset beta really is a fancy way of saying how volatile are the cash flows. And if I hear, the things like people piece, it probably plays into it on some level. But if I hear what you're saying, I would agree in the sense that if you can measure the volatility of the underlying cash flows, and by the way, the pivotal concept there is almost always operating leverage, right? Which is for every delta denominator, delta sales, what is the delta EBIT in the numerator, right? So for every dollar change in sales, what is a change in earnings? You're going to have a pretty good sense of that. And then you're going to introduce financial leverage, right? So financial leverage will amplify that impact. Or if you have negative financial leverage, in other words, you have more cash than debt, then that will dampen that effect, right? So I think I agree with you on all this. I don't want to get too worked up about this. I do think that it's important to understand that you're modeling the idea of opportunity cost. And when you're doing an expectations investing framework, the key is to try to capture what you believe is a solid estimate of opportunity cost of capital providers, right? So there are now many, many approaches to doing this, some more detailed than others. I'd be curious what you guys, what kind of numbers you guys come out with. The other thing I'll just say is that from a practical standpoint, this is just me speaking now as both, wearing my hat at Columbia Business School, but even as a practitioner, is that I've always liked the work by Aswath Damodaran on this, a professor at New York University. He is, by the way, incredibly generous about what he shares on his website. And every month he updates his estimate of the market risk premium. And, I think that gets you into low sixes for the market today, the S&P 500 in the United States. And, he's been providing these data back, or he has these data back to 1961. And we just did a really simple exercise the other day, which was, let's look at Aswath's equity, expected returns for the market based on his assumptions, and then look at the actual market total shareholder returns for the subsequent 10 years. And so, just see how practical it is. And it turns out the correlation is about a 0.7. So it's not perfect, but it's not horrible either, right? And so it's actually, I think, a pretty good way to think about this particular issue. And then if you triangulate that with credit spreads, perhaps you triangulate it with other tools that may be at your fingertips, things like implied volatilities or even credit default swaps and those kinds of things were relevant. I think you can sort of create a pretty decent picture for most businesses about what the cost of capital should be.
So I think it's always an interesting discussion. I think you made it really clear. I think I've heard many investors, including myself, ask, Buffett has said that he used a cost of capital of, or I don't know if he's really said it, but the common thread is that he has said that he uses 10%, but I don't really believe it.
Well, Buffett said everything, right? So he said 10%. He said you take a risk-free rate and add in a risk premium, which is essentially what the CAPM does. So if you read enough of his writings, he's basically said everything under the sun. By the way, one of the reasons I did that Damodaran exercise is because I wanted to compare it to that 10% rule. And the 10% rule gives you a vastly worse outcome and worse correlation. So that would suggest that what Aswath is doing, by the way, and what all Aswath is doing is, again, it's the same, basically it's all expectations, the same thing. He's taking the market levels, which he knows. He's using some normalized estimates of cash flows, and then he's backing into the discount rate that solves, right? So in a sense, these are all circular things that are doing the same thing. But the point is that gives you a better, what appears to be, and again, we have data back to 1960, so we have 60 years of data. It appears to be a more reasonable way to think about that.
Really interesting. Of course, we need to mention the risk-free rate. And we got a question on Twitter from a guy, Will Kane, who asked if investors should use today's ultra-low interest rates in their DCF models or project rising rates down the road.
This is a tricky one. But the answer is, I think you should use prevailing interest rates. And by the way, I'll mention the new McKinsey valuation textbook, which I think the most recent edition came out in the spring of 2020, so a year and a half ago. They actually have a section where they talk about creating, in quotes, a synthetic discount rate to try to accommodate. The reason that doesn't make any sense to me is because this is the world we live in. We don't live in the world we want to live in. And by the way, this is just my broader comment to people who like to complain about central banks around the world, complain about the Federal Reserve and so on and so forth. And by the way, as a hobby, you can complain about central banks and Federal Reserves all you want. I don't have a problem with that. What I think is, however, is that you have to be based in reality. So the world is not what you wish it were. The world is what it is. And so that's what you need to deal with. So to me, that's the answer there. And by the way, of course, credit markets themselves, including fixed income markets, are, again, forward-looking markets, right? So there are all sorts of things you can figure out by looking at markets and so forth. So I would not advocate for that. Now, the other thing just to be a quick comment on the side, which is it's important to be very humble about your ability to forecast macro variables. And, Phil Tetlock at University of Pennsylvania has just done extraordinary work. His famous book from 15 years ago is called Expert Political Judgment, where he actually documents the futility of experts in making these kinds of forecasts. And so anybody that sits around and says, I'm going to tell you interest rates will do this, that, or the other, right? You should be very skeptical about anybody's ability to do that. Now, that said, I think it becomes very worthwhile to think about scenarios and say, okay, let's think about the world, and where's a world where this set of facts unfold, and here's another world where the other set of facts unfold, and so on and so forth. And so just to contemplate those scenarios can be a very valuable exercise. But this notion that somehow I know that interest rates, and by the way, it's funny because I was looking back at my notes. I did a presentation in the summer of 2010, so 11 years ago. And I was at a conference with a bunch of chief investment officers of endowments around the United States. So these are very sophisticated, very large endowments. And there was a survey about, are interest rates going up or down? And interest rates were like, and of course it was like, I think it was a complete unanimous view that interest rates were going up. And this is, and of course it was dead wrong. So
the next year or on which?
Yeah, it was like whatever in the next 12 months, or but it doesn't make any difference. So the point that, so my punchline, all of that is to be macro aware and macro agnostic. And again, let's go back to the same point on the cost of capital. I'm actually very sympathetic to the idea that, simple things like CAPM have a lot of limitations. Beta, this is the whole point, is that Gene Fama and Ken French have written papers about beta and the limitations. And they actually have kind of a zinger in one of their papers where they say, this is like so limited, you shouldn't actually use it in the real world as a practical application. Right now, there are people that have counter arguments and so on and so forth. But this is what I tell my students, forget about the formula. Get that out of your head. Understand the concept, right? And the concept is the key animating concept, which is, what is the opportunity cost of capital providers? And that is not an impossible task to at least get into something that's sensible from the point of view of a business person and from the point of view of an investor. So I think that we don't need to, this should not be our religious war, right, on cost of capital. We can do better than that.
Yes. So the second step of the expectations investing process is to identify the most important trigger for changing your expectations. And which would you say are those? Which are the most important revisions in expectations that investors should focus on?
And I think that I would just slow down for 1 second and say that one of the most interesting chapters and one of the most interesting tools in the book, which I think is still very underutilized, is this thing called the expectations infrastructure. And we might talk about that some more, but the expectation infrastructure basically says, and there's a backstory about how we got into this, because, originally we were going to write we were going to write 3 chapters, and I was in charge of this, by the way. The first chapter was about those companies that are sales growth driven. Right. And I was like, oh, this is, I got this. This is great. And I actually wrote the chapter, and it came out pretty well. And so I was pretty excited about that. And the next was going to be a chapter about those companies that were margin driven, operating profit margin driven. And then the third was about chapter about companies that were investment driven. Right. And so I'm on that second chapter on operating profit margin driven companies. And I'm starting to think through the issues, and I find myself immediately running into a problem. And the problem is that the reason that margins go up or down is almost always because sales go up and down, right? So these are not independent things. There's fundamental interactivity between these things. So that got us to go back to this thing called the expectations infrastructure. So I hope the listeners can visualize this. On the left, what we call value triggers. And these are sales costs and investments. And these are every business everywhere in the world's got these 3 things, right? Sales, costs, and investments. Now, the problem is those are too blunt to map onto the value drivers, which is what we ultimately care about, which is sales, margins, and investment rate. So we need to refine them through what we call the value factors. And the value factors are 6 microeconomic shapers of these value triggers into the value drivers, right? And so, and step 2 of the book is to say, okay, let's figure out which of these value triggers is most important, and then to run through at the end of the product of the middle part is to run through scenarios of how good or bad things. So now the question you posed, which is a great one, which is which of these value triggers is most important, and it probably won't be shocking to hear that for the vast majority of companies, the answer is sales and sales growth, right? And so it's obviously the largest source of cash coming in the door and so on and so forth. But it also is the one that triggers 4 of the value factors, right? 4 of the 6 value factors are driven by sales. So sales is going to be by far the most likely to be the main thing for you to focus on. Now, is that ever not true? It could be things like you think about disadvantaged businesses. There are companies that have investment problems, so they're not investing at a high return on capital. You might think about like somehow a retailer that is opening stores for suboptimal economics. So for them, getting that straightened out will be more important than revenues, right? Because they just need to get the basic formula correct. But for the most part, that's the answer. And so the answer is almost always sales growth. And so the beauty of the expectations infrastructure and really the key to this whole second step is to allow you to do if-then scenarios, right? So what you ultimately want to do is to say, okay, sales is likely to be the most important value trigger. Let me think about, and now you've already got through step 1, you've already got a sense of what is priced in terms of the sales growth rate. Now you have to sort of step back and say, okay, how good could the world be? Or how bad could the world be? So you're now doing distribution of outcome scenarios for sales growth rate. And, I know you guys, we talked a little bit about this before, but one of the ways to really inform that discussion is to use base rates, right? So just to take one step back, a base rate, when we try to solve problems, the classic way for us to solve the problem is to gather lots of information, combine it with our own experience and input, and project into the future. And certainly when most of us build models, that's how we do it, right? We sort of we gather a bunch of information, we do our models, we build it up, we think, right? A base rate, by contrast, says, let's think about the world, like my problem, as an instance of a reference class, right? And the reference class is basically asking or answering the question, what happened when other organizations were in this situation before? So what we can do with base rates, for instance, is we can start to ask questions like, okay, this company has $3 billion of turnover. We can ask a question. Let's say it's in the technology or a healthcare sector, or whatever it is. We can now start to ask questions and say, okay, of all the companies with $3 billion of turnover that are in healthcare or technology, what has been the subsequent distribution of growth rates for the next 3, 5, and 10 years, right? And you can actually map that out. And by the way, these are not perfectly normally distributed curves, but if you envision bell-shaped distributions, that's going to get you pretty much into the neighborhood of thinking about these things properly. So you can start to take that framework and now reintroduce it into your step 2 of the expectations investing process and thinking about how good could things be and how bad could they be. Now, what becomes important is once you think about the upside scenarios and the downside scenarios, is you again go back through these value factors and say, if sales growth rates are much higher than what is anticipated, what will that mean for margins? Will they go up, and how much will they go up? If it's much worse, what will that mean for margins? Will they go down, and how much more will they go down? So now you're creating these if-then scenarios. It's a very, very rich tapestry, right, to allow you to understand what's going on with the business. And so with the outcomes, and then we can assign some probability to those outcomes, that allows us to go to step 3. But that's the product of step 2, is to say we're going to start to think about these various the value trigger is almost always going to be sales, and we're going to think about scenarios and the probabilities that those things actually occur that allow us essentially to shape an expected value for a particular company.
I just want to mention there that actually you have done a lot of work on base rates. I would even call you the guru on base rates. And I think if the listeners just search for your name and base rates, they will find the long article on that. And you updated it quite a few years ago, right?
Yeah, well, I would think, it's hopefully something we'll come back to. And you're exactly right. If you Google Michael Mauboussin, the base rate book, you'll find that it's 150 something pages. But what I would say is that for most listeners, reading the first, I can't recall how many it is, but the first maybe 10 or 15 pages of that report are really all you need, because it tells you about the ideas. But more importantly, there's another little interesting embedded point about this, is that some of this research allows you to understand the notion of regression toward the mean, right? And it's not just that regression toward the mean happens, which I think hopefully everybody understands that, but the rate at which it happens for various financial metrics. So when you go down the income statement and even to some facets of the balance sheet, there's different persistence of performance. And, so for instance, to state the obvious, sales growth rates, now again, not numbers, but sales growth rates are vastly more persistent than earnings growth rates, for an example. So having that information being at your disposal, I think, is an incredibly helpful thing. Yeah. So that the stuff, I agree with that. Of course, the stuff on base rates, and we'd like to do more. And I think, the biggest challenge is that we did it for sales and sales growth rates, which again is probably the most important one. But we also looked at things like gross profitability. We looked at operating leverage. So we actually documented for various sectors the degree of operating leverage. And by the way, analysts struggle with this, and companies struggle with this, by the way. They don't really understand fully, if revenues do this, what are the margins going to do, and so forth. And this is a very, very nice way to again fill out the expectations infrastructure, because the expectations infrastructure it gives you the tools to understand how and why margins go up or down. By the way, today, obviously, one of the big issues that people are wrestling with is that of inflation. And what we see are a lot of companies raising prices. And the expectations infrastructure is another really good tool for allowing you to understand what does that mean for margins, right? Because if the price increases are solely to offset cost pressures, that means no margin change, right? Or it may mean some margin degradation. By contrast, if you're able to price at or above the rate of all your input costs growth, that means margin could be preserved or actually expanded. So anyway, it's a very, very, very powerful component. And I would just say, that if you said to me that what are the two tools that remain underutilized that, in general, one would be the expectations of infrastructure, which I think is a really powerful way to think about if-then scenarios. And then second is base rates. I actually think that's it's remarkably underutilized in the investment world, given how powerful it is. And, you see it more and more happening in other fields. By the way, talking to Phil Tetlock, I mentioned him a moment ago on forecasting and how experts are really bad. Phil's more recent work last decade or so is on this idea of super forecasters, which itself is really a fascinating body of research. But one of the things they did is when people came to their forecasting tournament, they trained them or didn't train them. And people who got trained did better than those who didn't get trained, not shockingly. But it turns out one of the interventions that's most important and useful is actually simply teaching. And as I'm talking about, like an hour of teaching people about base rates. So it seems to be a lesson that people can internalize and apply pretty readily. And yet, I don't know. I didn't come to this till I was very late, relatively for me, late in life. And certainly, does anybody in college learn about base rates? I mean, I don't know. Do you guys learn about base rates in college? And it seems like it should be like, man alive, it should be like you should never graduate from college with any degree until you've learned about this concept, right? So anyway.
Do you think people are learning the wrong lesson from looking at the largest US companies now?
In what way? Like in the fact?
No, I mean they have more or less they have been able to manage with high sales growth, maybe higher sales growth than what's depicted in the base rate.
Yeah, so that you may have seen, we wrote a piece about that earlier this year, and this will probably be a component of what we'll write about as we issue the next sort of version of all this stuff, which is this goes back to our discussion about intangibles. And I think what's happened as intangibles have become more important, the key to intangibles is that there's greater potential for scalability, which means more rapid potential growth. But there's also greater risk of obsolescence, which means if your code or whatever is not relevant, it goes to zero very quickly. So if you imagine a bell-shaped distribution of growth rates, for instance, for a population of companies in the past, intangibles become more important, I think what's happening is that bell is getting fatter, right? A little bit more on the right tail, which means some companies are able to grow faster than what we had thought before, or at least what history indicated, not what we thought necessarily. And then a more rapid obsolescence. So some companies going to being irrelevant at a faster rate than what we had seen before. So I think that's relevant. Now, in the sports analytics stuff, there are plenty of techniques to deal with this. And one of the techniques that I've always found interesting, and some method of which I think we're likely to try to utilize as well, which is you look at a history of base rates, right? And again, our data, the original thing in the original book was back to 1950, right? So this is a long time. You don't want to throw away the data, but what you end up doing is taking all the data in the series and then you weight it, placing a greater weight on the more recent past and then a lesser weight on the more distant past, right? So you're preserving all the data, but you're weighting things as new information comes out. So because base rates are not, just to be super clear, these are not chiseled in stone, right? These are not meant to be some sort of statement from on high. These are living, breathing, changing distributions. So there's a risk of over-relying on them. My argument would be, broadly speaking, we're vastly underutilizing them, right? So the risk is much less not paying attention to them than misusing them, but you can, of course, misuse them as well. So just to be thoughtful about that, that's one technique to allow us to do that. So we wrote a piece about that earlier this year about intangibles and base rates, and I think that's a good admonishment, just to be aware that these are not tablets held down from high that you need to adhere to under all circumstances.
When we're into the subject of intangibles, I also wanted to ask you about that many of these types of companies that we mentioned, the largest technology companies, for example, but many technology companies in general share the same characteristics in that they invest a lot in marketing, in R&D, and so on, which they expense directly on the income statement. They don't put it as an asset and write it down over time. So it should mean that profits are, if they would do that, the profits would be higher on the income statement. And I just wanted to get your view on that, as well as maybe a comment on what's your view on the Schiller PE. I mean, which has been used as a check for the market valuation in general.
So your observation is exactly right. One of the things I would just emphasize is that in all these adjustments, and we've written a fair bit about this going back to a report we wrote a little over a year ago called One Job, which documented these data for Microsoft. And what it showed, very much to your point, is that earnings are much higher than what is reported, but by the same token and mathematically offsetting it, investments are higher as well. So the first thing just to emphasize to all the listeners is that free cash flow, which is the cash available for distribution to all the claim holders, does not change with these adjustments. What changes is a reallocation, as you point out correctly, from something that was an investment embedded essentially in the income statement. So we're replacing it. So earnings go up and investments go up by the same amount. One of the things I always like to point out is certain iconic US companies, including Walmart and Home Depot, had negative free cash flow for the first 10, 15 years that they were public. Well, that seems weird, right? Because, Walmart was profitable every single year, has been profitable for every single year for a very long time. But of course, the difference between Walmart of the 1970s and contemporary companies today, exactly what you point out, is that their investments were primarily tangible, right? And by the way, even Walmart was ahead of its time in technology, but for the most part, their investments were tangible, and that is new stores and fixtures and inventory and so on and so forth. So they had negative free cash flow. So this idea that we dwell on income statements as, and by the way, so the poster child for all this, of course, is Amazon.com, which is a company that's invested very heavily, as you point out, in all these items like research and development and marketing and so forth, and sales and marketing. And I think that the public statements, the earnings statement in particular, has substantially misrepresented the underlying economics of the business. Now, the flip side is that their investments, which have always been large, are actually even bigger than people think, right? Which is actually, from an investor's point of view, a very interesting point, because it again compels you to think about the magnitude of investment and return on investment. Because if you understand the magnitude of return on investment, that's basically your future earnings, right? So that's all important. And just to give, again, some sort of grounding on this, I had mentioned sort of that CapEx and intangibles were even, it's now 2 times intangibles to CapEx, right? So again, in 20 years, a very material change. On the Shiller PE, we were actually in our PE multiple report, we wrote a little bit about Shiller PE, and I think that there had been some limitations. There are some limitations to that PE multiple that, by the way, Jeremy Siegel wrote about at University of Pennsylvania, and I'm sympathetic to some of Siegel's criticisms. By the way, Jeremy Siegel and Bob Shiller are good friends, so I think this is something that's an interesting academic debate to some degree. But I think your broader point is the one that I want to keep focusing on, which is that if we are markedly misrepresenting earnings, and I think we are, as a consequence, measures like that will become less relevant, and certainly their historical, the historical multiples as applied to today's world become less relevant. So, I'm pretty conservative on these things. I actually like to see history. I like to understand all the, what's happened in the past, but I just think that this is such a market change over the last 20 or 30 years. I started in the investment industry in the mid 1980s, and it wasn't until the early 1990s that there was the crossover between intangibles and tangibles. So in my investment career, I've seen all this stuff happen, and as a consequence, people just should be very careful about simplistically looking at multiples and ratios like that.
Moats is another area where you are a thought leader, and in the book you write that the surest way for investors to benefit from expectations revisions is to anticipate shifts in a company's competitive dynamics. So what is your process for analyzing the competitive position and strategy?
I love that line, by the way. I still like that line. I like it. Like, who wrote that? Oh, that's good. That's good stuff.
I agree.
So, I think chapter 4 was a substantially revamped chapter, and it's about competitive strategy. Obviously, we can't do it full justice, the topic, because it's a very rich, huge discipline in and of itself. But, we try to come at it in 3 particular steps. The first is what we call lay of the land. And that's things like drawing an industry map to allow you to understand all the different characters and competitors, to think about concepts like profit pools, to understand who's making money, economic profits, and relative size of markets. There's a very nice old concept around, it's called the market share test, which basically says how stable are market shares in a particular sector. The premise being when they're stable, that tends to be indicative of the potential for competitive advantage. And if they're moving around a lot, that tends to be unsettled territory. And another one that I've always liked a lot is entry and exit data. I think this also gets ignored a fair bit, right? Which is, if you actually study entry and exit, it tends to be much more significant than people think and perceive, right? And so, and obviously entry exit has a lot to do with where you are in your life cycle as an industry. So understanding entry exit, I think, as one of these other measures, is a really good way to understand what I would call lay of the land. And then the second level is industry. And here, I just would appeal to very conventional tools, in particular, Michael Porter's work on 5 forces, I think remains a really powerful way to think about this. And in particular, we placed emphasis on barriers to entry. My colleague at Columbia Business School, Bruce Greenwald, says there's only, there's only one barrier to entry, only one force that matters, and that's barriers to entry. But I'm not sure that's quite true. But barriers to entry are very important, and rivalry is important as well. And then we also introduced there the Christensen work on disruptive innovation, which I also think can be very, very helpful. And then finally, the third step is firm-specific advantage. And the idea is, if the company you're studying is generating high returns on capital, the question is what underlies that positioning, right? Is it, for example, generically a low-cost producer? Is it generically a differentiated product? And how do you think about that? And one of the ways to to disassemble that is to think about value chains in particular. And the one thing I'll say about strategy, if you read Porter carefully, one thing that Porter, the points he makes that I think is really important for people to always take home is that strategy is ultimately about trade-offs. And so strategically, for you to articulate your strategy, if you're doing one thing, you're not doing something else, right? And you've made a trade-off. And so to really understand a company's strategy, you have to understand the explicit trade-off choices that they've made. And the value chain is often a very good way to expose that, to break down a value chain for a particular company relative to its peers and so on and so forth. We used in the book, our case study was Domino's Pizza, which, it's a franchise business, it's a great business ultimately. But one of the decisions Domino's made that, in some environments seems to be bad and some environments tends to be good is that they don't really have sit down place to eat pizza. So you don't go to Domino's to sit there and eat pizza. It's essentially a delivery or takeout type of organization. And so that's a trade-off, right? And there are going to be bad things about that. In other words, people are not going to come and hang out at your store and so on and so forth. But there are lots of good things about that. For example, you can locate your stores in lower cost places. You can make the kitchen much more efficient. You can simplify certain things in certain ways and so forth. And so that's that last thing I'll just say on the strategy stuff is that, and you think about moats is this idea of understanding trade-offs in particular. If a company is doing one thing, what is it not doing?
It's hard as an investor to really, what you how to prioritize that, because no company will be perfect in that sense. So you really have to deal with that.
Yep, absolutely.
So the last and third step of the expectations investing process, it defines the clear standards for buy and sell decisions. And it's a simple but not easy question. What is required to buy a stock?
So if, just to reiterate what the output of step 2 should have been, hopefully I said it clearly enough, is you created these scenarios for your most important value trigger, so that's sales, and outcomes that were the result of those, right, after running it through the expectations infrastructure. And then you ran it through your models. And of course, that gives you ultimately a stock price. So now you have a bunch of high stock prices, a bunch of low stock prices. You obviously have in the middle of that range is where the current stock price is. And then we want to assign probabilities to those scenarios coming to pass. Those probabilities should be or can be very much informed by base rates, right? So we have the basic apparatus, hopefully, to allow us to understand outcomes and probabilities. And with those outcomes and probabilities, obviously a stock price, we can then generate an expected value, right? So it's just the probability times the outcome of each of the different scenarios summed together. And so what we argue is you want to buy a stock, you want the expected value to be meaningfully higher than the current price. And a sell would be the exact opposite. Now, we are non-prescriptive as to what margin of safety is appropriate for any particular individual, right? Because, you might say, well, gee, if it's within 10%, there's so much error in what I'm doing, it's not going to be sufficient. I think that's probably right. So you want to pick whatever threshold gap between expected value and price that you think is sufficient to accommodate your mistakes potentially and other bad things happening and so forth. But that's basically it. So if it's cheap, you buy it. And if it's expensive, you sell it. And by the way, even going through the full process, more times than not, the answer might be, got nothing to do here, right? Like, I don't really know. Like, the market's got this about right, or I don't have any view that's different than the market. Because the other thing is important just to emphasize is that if you're buying it or selling it, what you're saying effectively is that you have a view of the world, a probabilistic view of the world that's different than what's priced in, right? And more optimistic or more pessimistic. So that's really the key. So that is, when you say what's required to buy a stock, we don't prescribe what any particular investor may deem to be appropriate, but that's the basic framework.
And you also bring up the house money effect, and that reminds me of Dan Ariely's great book, Dollars and Cents. So can you tell our listeners a little bit about that?
Yeah, the house money effect is really a concept of mental accounting that was developed by Richard Thaler, I think before Ariely. So Thaler, of course, won the Nobel Prize in economics. Mental accounting basically says that we tend to, even though all money is fungible and it all should be deemed to be the same, in our minds, we tend to put things in different buckets, right? Different accounts. And so, for instance, you might imagine that you bought a stock at 50 and then the stock proceeds to go to 100. So that's really good. What most of us typically do is we think of the first 50 as we want to be safe about that, right? Like we're risky. We want to risk that. And then the other 50, the new 50 is kind of like, it's kind of free. So this is that's the house money, right? It's kind of free for us, whatever. And so if it goes from 50 to 25, that's bad, but it was easy come, easy go kind of thing in the first place. And, the house money effect was really, I think, first designated by gamblers, so if you go to the casino and you make money, above your original bankroll, you sort of are looser with your winnings than you are with your original bankroll. So again, it's one of these things that's counter to pure economic theory, but completely consistent with human nature, right? We all do mental accounting all the time. And by the way, it's so funny because I'm a big like mental accounting person. I do all this stuff all the time. So I say to my wife like, I got this, and so this is going to go to offset that. And she's like, that's not how it works. I'm like, yeah, that's how it works in my head. So I think it's for the most part, it's probably pretty harmless. But the issue can be, of course, if you start to think about things, I have to believe just in, for example, our speculative world we've lived in certainly since COVID, right, last couple of years, there have been a lot of investors that are participating perhaps for the first time. And many of them probably done very well or could have done well in a short period of time. And yeah, so there's probably a lot of the house money effect going on out there these days, even now.
A question I have to ask in the podcast you have done before and so on. The questions are rarely about your own investments, but I guess you invest your own money sometimes as well. And do you then use the expectations investing framework?
For the most part now, and this has been true for years, most of my own investing goes into our funds. And so, and obviously our funds are, diversified funds and so on and so forth. So I don't do that much of it myself. But, it's interesting, I have owned some stocks for a long time. I've owned the two stocks I've owned probably for the longest time, this is 20 plus years, would be Berkshire Hathaway and Amazon.com. And they're both ones, because this is probably a fair question, which I bought them. And, by the way, they've gone way up and way down and way up and way down. I just haven't done anything with them. I don't sell them. I don't buy them or sell them. Right. So they've both compounded at a pretty good rate. And so it's an interesting, especially with Amazon.com along the way, it's probably pretty likely that had I done an expectations analysis, there were certain pockets where it probably would have appeared to be high expectations. Now that said, and we talk about this in the chapter on selling, there are certain frictions to selling too, right? Including tax consequences and the fact that you have to redeploy the capital and sort of make back the taxes that you lost. And so in many instances, and that's not true for example, non-taxable accounts, but for somebody like me, that is important. So I am one of those path of least resistance is to do nothing, or kind of the Buffett, buy and my holding period is forever kind of thing. So
sit on your ass investing, as Munger says.
Yes, exactly. That suits me very well.
And you could have done worse with those two.
Definitely.
Something you wrote, I think it was last year, you wrote a piece on public versus private, and where you show that the payoff for private deals, so I switched subject a bit here, the payoff for private deals looks similar to an option where the median loses money, but where the big wins make up for it. Considering that many businesses in the public markets, especially in technology, and maybe a bit biased here because we cover smaller technology firms, they are often early in their journeys and they are often money losing. And I wanted to ask, how do you think investors should incorporate this into their own portfolio construction? I mean, usually we spoke about Munger, and he has said maybe you should own a handful of stocks, and other thought leaders have said similar things. So I want to hear your view on that.
Yeah, well, I think that a couple of things come to mind. Certainly, as you point out correctly, when you have those kinds of payoff schemes, some measure of diversification makes sense. Now, even in venture funds, they'll have 10 or 15 positions, right? So the premise is that they are going to have 2 or 3 things that sort of carry all the freight for the overall portfolio. The other thing is to say that, work with which I'm sure you guys are familiar, is Henrik Bessenbinder at Arizona State, just has demonstrated that the majority of companies failed to earn treasury bill returns over time, and a relatively small, and this is not just in the U.S., this is around the world, and a relatively small percentage of companies essentially pull all the value creation freight for everybody. So if you compound things over some period of time, it's not that different a situation for public markets. In the report, by the way, you cite, I love that chart, by the way. I thought that was cool because we put in public equities versus buyouts versus venture. And it was I don't think that chart's ever been done before. That the data on buyouts and private and venture was brand new, and we added the public stuff. But again, we only use public data over 5 years, right? Because that was roughly the holding period for venture and for buyouts. So now look, the fact is, somebody like a Munger would say, if you have access to just a great business, whether it's the Costco of the world or an Amazon or whatever it is, and it proves to be, you're convinced and it proves to be a great business, then you should latch your star onto that thing and hold on, right? So now the premise is that we can identify those, and we can identify them early enough, and so on and so forth. And that seems to be a pretty tricky thing. So I think for most of us mortals, the proper advice is to have some sort of diversification. By contrast, if you really do think you've found a truly unique business with lots of runway for potential growth and so on and so forth, that's where maybe a little bit more concentration would make sense. But for most people, like that's tricky advice to implement.
And for small caps where there is no consensus forecast, what is your view on using the expectations investing process?
I think it still works, and that's, this is a good question, because one of the things you can do is, and for example, if there's zero record whatsoever, but if there's a little bit of history of the company, you have some sense of, for example, growth rates, what they've enjoyed in the past, and profitability, and so on and so forth. The question is whether you can create a fairly credible set of expectations, even yourself, that would solve for today's price, that seem to be sensible given the overall environment, the industry in which it competes, the company's past performance, and so on and so forth. And then you sort of go from there. So I'm sympathetic to the point that it's nice to be able to confer with consensus numbers or other companies that are similar, doing similar things, and sort of be able to sort of check against different sources like that. But it's still the same. It's still the same basic concept. And by the way, even if you're not doing expectations investing, you're still projecting numbers, right? So this, you can pose the same question of your model, either direction. So I think it still would work.
And the hard part is when it's a nascent company and they have no experience, you have no track record, and there's just expectations going forward, and how you use to, of course you can discount the cash flows, but there's another value asset, and you tell us very good in the book about real options. So maybe you can elaborate a little bit on that.
Yeah, I would just say that, real options are important, but I would just say we should, the first thing to do is really to understand the underlying economics of the business. So I think you can still do that. But just to touch a bit on real options. So real options are analogous to financial options, but they apply to real investments in quotation marks. So that's why we call them real options, right? So this is investments in the business. And they typically are valuable for businesses that have certain type of characteristics. And the first characteristic would be that you have to operate in an industry that's fairly uncertain. And by uncertain, that means there are lots of range of possible outcomes. Now, interestingly, people talk about volatility tends to be bad for discount rates. That means they're high, and hence that means present values are low. But of course, for an option, the higher volatility is more valuable, right? Because it's asymmetric. So you only exercise if things are advantageous for you, and it's the right but not the obligation to act. And so volatility actually is good. So uncertainty tends to be good. Second is good managers. And by good managers, we mean executives who can identify and cultivate and ultimately exercise options intelligently. Now, in the original version of the book, our real options case study was Amazon.com. I mean, that was probably more lucky than anything else, but that proved to be a pretty good example of a real options type of company. And, you think about AWS itself was probably just at the end of the day, a gargantuan real option that the company was thoughtful enough to cultivate and ultimately exercise. The third thing is it helps to be market leaders. And the reason that helps is because you often get the first call for possibilities for joint ventures and so on and so forth. And then the last thing, which is really important, is access to capital. And so notwithstanding, for example, the dot-com, there's a lot of really exciting stuff happening in 99, 2000, but then we went through a 3-year bear market. And there were a lot of interesting businesses still developing interesting technologies, but there's no access to capital. So even if you had option potential, if you can't exercise your options, it's not very valuable. The case study we used in the 2021 version of the book was Shopify. And, I think Shopify actually has many of the same characteristics as a 2001 Amazon.com. It's obviously got much more solid footing and so forth. But the idea that, there are a lot of different businesses, they think about this way, they're global, and they're a leader in what they do and so forth. So we'll see how we'll get together in 20 years from now and see how our Shopify example worked out. But that's what a real option is. So the point of the discussion in the book is not that we want to kind of go crazy with real options and see them everywhere and place value on them everywhere. But by the same token, we also want to be aware that just because you don't have things you can touch and feel today doesn't mean that there isn't value in some way, shape, or form. So it's trying to find that middle ground between being thoughtful about it and having the analytical tools at your disposal to be able to think about it, but to not go overboard.
Maybe Tesla is a good example of that.
Well, Tesla is a good example of maybe two things. One, certainly real options, and I think that there's something to that. But also in that same chapter, we talk about reflexivity. And, reflexivity is, I think it's an idea that's been around for a very, very long time, but it was popularized by George Soros, and it's basically a positive feedback. And, we often like to think in economics that there's a very famous book, by the way, by Donald McKenzie called An Engine, Not a Camera. He's an economic sociologist. An engine, not a camera. So he's like, what does that mean, right? And I think economists like to think, or even financial economists like to think of ourselves as walking around with cameras, just taking a picture of the world. And even as investors, we think we have a camera, so we take a picture of what a company is. And McKenzie's argument is no, in fact, it's an engine, because the very fact you build models and act on those models changes the nature of the world itself. And that's really, to me, what reflexivity is about, which is that we think of fundamentals and sort of the stock price as two distinct things. But in fact, it can be the case that the stock price can affect the fundamentals and vice versa, right? And so that's a good example, I think, where they've been able to create stories that allows the stock to do well. And that's given them access to capital, and like the real options things fit into this stuff as well. And, one way to think about this, to make this really concrete, is that you could think about, we talk about in chapter 11 about buybacks. You can sort of demonstrate mathematically that if a company buys back undervalued stock, that benefits the ongoing shareholders, right? Essentially, the sellers lose out because they're getting less than what the thing is worth, and then the ongoing shareholders get more of the pie, essentially. But mathematically, the exact opposite relationship would be true. If you sell overvalued stock, the ongoing shareholders benefit as well. So you think about a lot of these meme stocks. Again, you can debate about what they're worth in quotes fundamentally, but once their stock is much above what you think the fundamental value is worth, the degree to which these companies sell stock, and most of them have, that actually benefits the per share intrinsic value of the underlying business, right? But mathematically. And so it's a very interesting thing that there's a feedback between these two things. So reflexivity, I think, is also something that's really important to bear in mind in markets. For most things, it's just not a big factor for most companies, but from time to time, it rears its head and becomes really significant. So I think, Tesla, again, you can, whether you love it or you hate it, there are a lot of really interesting aspects of it. And then the other thing I think is when we talk about optionality, real options, that's very difficult to really think about completely at this juncture, is just the value of data, right? So we just know that companies around the world are gathering sort of unprecedented amounts of data on their customers and performance and so on and so forth. And the question is, how or can that be monetized in a way in the future that we don't understand today?
So expectations investing is about reading the mind of the market, but as an investor, you also need to deal with your own mind. So what are your most common biases?
Yeah, well, I already mentioned my mental accounting. I don't know that I'm any different than anybody else on this stuff. I think that the ones that I typically talk about are overprecision and confirmation bias. So I'm probably as guilty as the next person on those kinds of things. I will say that I do try to think a lot about this stuff. So I try to be mindful of it. Every time my wife says to me, "Are you sure about that?" I say, "I'm not sure about anything," but pretty sure. So I try to be pretty mindful about it. But I think I'm probably the same as everybody else. I mean, I've had the opportunity to spend some time with Danny Kahneman, and Kahneman himself has conceded that he falls for every one of the biases that he talks about. And for heaven's sakes, if Danny Kahneman's doing it, there's no way a mortal like me is going to be impervious to that. So, yeah, I would say it's the same stuff. Now, that said, the big ones for investors specifically, and we could talk about why that could be problematic, are overprecision and confirmation bias. So, overprecision is one. The broad concept is overconfidence. But there's a really wonderful book, by the way, by Don Moore recently. It came out last year, I think. And it's about and Don is one of the great guys who's done work on overconfidence. And he dissembles overconfidence into three subcomponents. And the one I think that's relevant for our discussion is overprecision, which basically says that we think we understand the future more precisely than we do. And the way that manifests is that we project ranges of outcomes that are too narrow. Right. So, by the way, most people don't have a problem laying out scenarios and saying, "Oh, if it goes well, it's this, and if it goes badly, it's that." And, okay, and here's my base case and scenarios. People can do all that perfectly well. But almost invariably, their first pass at that will be a range of outcomes that's too narrow. That's going to reflect that overprecision. So this is the counter to that, right? The antidote to that is base rates, right? Because base rates will show you that you're being over precise. And then the second one is confirmation bias. And, confirmation bias is this idea that we tend to seek information that confirms our prior beliefs, and we dismiss, discount, or disavow information that goes against our views. And if there's information that comes in that's a jump ball, it always goes in our favor, right? Now, the reason that's important is because one of the essential tasks of an investor is to be a good information updater. right? So you have a prior belief of the world. This is, by the way, super relevant for expectations investing. You have a prior belief of the world. New information arrives. It is your responsibility to adjust your beliefs in the right direction and to the degree to which you can do it, the right magnitude. And what confirmation bias does is blocks that process, right? So the degree to which you can dismantle confirmation bias, that's really important. So how do you do that? I mean, that's a tricky one as well. But one of the key things is to write things down and start to keep track of your forecasts. And there's and that will allow you over time to get better calibrated, to be able to make better probabilistic forecasts. And if you really strive to make good probabilistic forecasts, you will practice it, but you have to sort of shake off the confirmation bias. I tweeted yesterday about, there's a little update about super forecasters, and one of the observations is super forecasters are very well calibrated. And so in plain words, what that means is when they say there's a 70% probability of something occurring, it happens 70% of the time. When they say 20%, it happens 20% of the time, right? So they're very good at putting things in the right probability bins. And Phil Tetlock, again, University of Pennsylvania, sort of responded to that tweet by saying something like, how do people get so good at this? They practice, practice, practice. And so the sooner people start to practice these things, the more they can fend off overprecision, the sooner they can fend off confirmation bias. So you have to be pretty active about it, but those are some techniques that would allow people to be more effective.
Yeah, that tweet is from November 15 then. And one way to help us with all these biases, and like you are also a thought leader on decision making. So technology, artificial intelligence is coming, and we know that computers are unemotional. So we must ask you how you think that if the expectations investing process could be automated, and how would that work?
Well, it's an interesting question. I think that I do think it's a valuable question to pose about the investment process in general. Should components of this be, or can components of it, do they lend themselves to being systematic versus judgmental? And my guess is that some things are systematic, could be systematic versus judgmental. There's, I'll just say that there's a fascinating passage in Danny Kahneman's new book, with Olivier Sibony and Cass Sunstein, called Noise. There's a fascinating little passage where they talk about a scientist who studied people, and he asked them like how they made decisions, and he created a model of those people based on what they told him. And then he went out and observed the performance of those actual people making decisions. And it turns out the model of the people did better than the people themselves, right, in making these decisions, which is itself a fascinating thing, right? So people know what they're supposed to do, and they can explain what they're supposed to do, but whether they do it every single day is another question. So that's one aspect of it. The second thing I will say, though, is that, and I should mention that my oldest son is a data scientist and has spent a lot of time studying machine learning and artificial intelligence. And so he's my kind of go-to guy. So when I have questions about these kinds of things, and I think that by the way, these are wondrous tools, and they're going to do things for our lives in the next upcoming decades that are going to be, I think, on the balance, very, very good. The challenge is that, and judgment's not going to go away in the investment world. And the reason is that there's no AI program or machine learning program that can anticipate how the future is going to unfold, right? And so, for instance, we might say, we might sit around and we'll have a beer after we talk, and we'll say, hey, let's talk about the future of electric vehicles. And, let's pretend that electric vehicles will be X% of all vehicle sales, and how our infrastructure is going to change to accommodate that, and what that means for, and so it would be very clear that we'd be able to run through a bunch of first order effects, second order effects, third order effects, maybe even fourth order effects, right? And these would be lots of interesting and complicated things, but they would be ultimately judgments. And there is no computer program that can do that now, right? Because you have to train these things based on what has happened in the past. And so as a consequence, there's going to continue to be, certainly in the world of investing for the foreseeable future, a prominent role for judgment. Now, I mean, you could debate. I just mentioned about how experts are really bad at forecasting. You could argue that humans are not going to be very good at forecasting at all. But again, we also know that some subset of people are actually pretty good at this. So if you train yourself and think about things properly, I think there's some hope that judgment will continue to be a valuable component of overall decision making.
On the concept of decision making, I mean, I think in your book Think Twice, you mention some tools that people can use to improve their decisions. Well, one is of course checklists before the decision is made. Another one is a pre-mortem. Maybe you can tell our listeners a bit on what is a pre-mortem.
Yep. So pre-mortem is, so we all know about post-mortems, right? So in other words, the patient has died and we gather and say, given the information we had at the time, could we or should we have done something different to lead to a better outcome, right? So essentially we are learning from our mistakes. And we're also very familiar with scenario analysis, right? So we stand in the present, we look into the future to say, again, upside, downside, and so forth. As the name implies, a pre-mortem is actually a third exercise. It was developed by a psychologist named Klein. And what we do now is we launch ourselves into the future and think back to the past. In particular, what we do is we pretend like we made a particular decision, let's say in our instance, an investment, and that this investment turned out very poorly. Right. So so poorly, we don't want to talk about it. Right. we don't want to see each other in the hallways kind of thing. Right. And so now this is November of 2022. Right. So it's a year from now, roughly speaking. And what we all do, and we presume this investment, we made it and it turned out poorly. And then what each of us does is independently writes down the story as to why this investment turned sour. Right. And it turns out that the pre-mortem, for reasons that have some sort of intellectual, interesting psychological components to it, that the pre-mortem opens up the mind a little bit to allow people to think about and contemplate scenarios that they wouldn't have otherwise contemplated. By the way, I listened, there was an interesting podcast with Klein, and he actually talked about another aspect, which I found fascinating, which was often in group settings, there's a very hierarchical structure. And so the senior person tends to take up most of the oxygen, and it becomes very difficult to voice your views, politically or otherwise, if you're one of the more junior people. But if everyone's asked to write a pre-mortem, right, the issues get surfaced to the table. And maybe I'll just tell you one quick story on this, which I found interesting. So this is at a prior investment firm, and we had an investment committee. I actually was part of this committee. So I was one of the committee members on this. And we had a team come in, they presented an investment idea, and these guys had done great work. And it was a multi-hour presentation, and we asked a bunch of questions, and they went back and did a ton of follow-up work. And then they came back and they presented another few hours on this. And again, lots of back and forth questions and so on and so forth. Well, it turns out that the discussion, we ended up focusing on just a handful of things based on sort of it was like the path dependence of the conversation. So at the very end of it, I said to the chief investment officer, I said, we need to do a pre-mortem on this thing, right? Because we need to say, we're going to pretend we do this and it turned out badly, because I'm not sure we got all the issues on the table. And turns out we did a pre-mortem on it. And 2 or 3 significant things ended up surfacing that had not been part of our 5 or 6 hours of discussions. And by the way, again, I'm not blaming anybody. I mean, this is the investment team was doing their thing, and they were engaged and they were responsive and so on and so forth. It just was the nature of how the conversation flowed. And there's an example where, again, now we identified a couple nodes that were relevant that hadn't been fully vetted before. So pre-mortem allowed us to see that in a more effective fashion. So it's a really cool little technique. By the way, it's cheap, it's inexpensive, it's easy to understand, it's easy to implement, and I think can give, again, people some good insights.
You really draw from so many different multidisciplinary themes and different topics. It's fascinating. And something that I thought about is, how do you decide which is your next discipline that you want to evaluate and look at? And which one is it right now for you, for example?
I wish I were disciplined about any of this kind of stuff. Well, we're working on now. It's some more stuff. There are two topics. One is additional work on the concept of maintenance versus growth spending for organizations. And part of this was inspired by a recent PhD thesis at Columbia Business School about, and the paper's called Estimating Maintenance CapEx. And the author, I think quite provocatively claims that depreciation amortization, which is typically deemed to be sort of a proxy for maintenance CapEx, substantially understates the actual amount. And of course, that's important because if you're spending less on if of your CapEx budget, less is going to growth and more is going to maintenance than you think, that means your growth prospects are going to be more limited. So that's one thing. The second one I'm working on is a topic which I've always I thought a lot about, and this is going to consolidate a bunch of different threads on the topic of feedback. Feedback is really hard in the investment business, in part because, the ultimate feedback, of course, is how your portfolio performs. So let's just be clear that that's ultimately what we're after. But the question is, can we create sources of intermediate feedback that allow investors and portfolio managers to be more effective? And so this report is going to go through a little bit of what are the raw materials of the types of people who are good to have on board in terms of the investment process in general. How do we, interesting questions like, if you're an investor, how do you think about the balance between practice and play, right? So if you're on a football team or you're a tennis player or whatever it is, and certainly you're at an elite level, that there's some balance between practice and play. In the investment industry, what is that balance? What should it be? And what does practice mean? And what does play mean? Those are interesting questions. Then the next section is really how we embed it in organizations. So we have our own cognitive abilities, but that can be enhanced or detracted or something in between based on our organization. And then the last is how do we get better at giving ourselves feedback? And I mentioned the Tetlock stuff. This is really about creating a little system for yourself to improve your ability to get calibrated, your ability to make probabilistic forecasts. And the only way to do that is, as I mentioned, is to practice. And so how do you set yourself up to do that? By the way, what you'll find is when you start to have to attach probabilities to all sorts of stuff, immediately you're going to start searching for base rates, right? So that's a nice little feedback that getting people to be more overt about base rates.
Can't wait to read all of those interesting topics. So this being a book podcast and knowing you own several thousands of books, and we see a couple of them in the background right now, we have to ask you which, if you can name 3 books that have influenced you the most to make you the person you are today.
Yeah, that's an impossible question to answer, but
3,000 books.
I think I'm going to give you 3 books that start with the letter C. How about that to make it interesting? The first for sure actually is probably the number 1 book, and that's Creating Shareholder Value by Al Rappaport. And so I've mentioned this many times. It was for me a professional epiphany, and really changed my life. It continues to this day to change my life. And the 3 lessons that I learned from that is that it's about cash, not accounting numbers, and that strategy and valuation have to be thought of together when you're doing valuation work, and that stock prices reflect a set of expectations. And so obviously it was a joy to write the original version of Expectations Investing with Rappaport back in the late 1990s, early 2000s. And it was an even greater joy to write the revised version with him this most recent past. He's now in his late 80s. He's a delight. I talk to him frequently. The intellectual spark is, or a flame really is full force with him. And we have great conversations. And, it's shocking how much, I think we're learning together and challenging. But I will just say that as someone, for me to have someone like that, to be a mentor, to be a collaborator, to be a teacher, behind the scenes, it's hard for people to know, like, there are a lot of days as a teacher, I wonder about I'm concerned for my own types of issues and I don't understand things. And I just talk to him, and just talking it all out becomes really powerful.
Is he like your mentor in that sense?
Oh, yeah, definitely. And so the second would be Complexity by Mitch Waldrop. I'm not sure that today Complexity would be the best book to read about the Santa Fe Institute, but it's an extraordinary book about the early days of the Santa Fe Institute. And the Santa Fe Institute itself has been a very powerful influence on me professionally and personally as well. And so it's really, the Santa Fe Institute is a non-degree conferring institute that has no disciplinary boundaries and studies evolving complex systems. And Waldrop captures that. By the way, one of the canonical examples of an evolving complex system is the stock market, right? So that would be my second C. And then my third C would be Consilience by E.O. Wilson. There's the book that's on my nightstand now is a beautiful new biography of E.O. Wilson by Richard Rhodes, who himself is a beautiful writer and biographer. And consilience is a very old word. It's about the unification of knowledge, and it's about taking ideas from various disciplines. For those who are Charlie Munger fans, of course, this is exactly a Munger type of mental models type of approach, right? So learning the big ideas from various disciplines, bringing them together, that's what consilience is about. And what I reading this book about Wilson, I didn't know some of the debates that had been happening. He was made a tenured faculty member at Harvard when he was very young, in his late 20s. And he was actually there around the same time as James Watson, who won the Nobel Prize, obviously, for his work on DNA. And the sense was that biology should move toward molecular biology, right? They should be about this chemistry. It should be about the fundamental components. And that guys like E.O. Wilson are, they're collecting butterflies or ants or whatever it is, right? But it turns out that this is actually what consilience is all about. And Wilson in this book makes this argument that reductionism has been incredibly powerful scientifically in the last 400 years. But for us to advance, really, it's about the unification of knowledge. It's about bringing things together. And many of the vexing problems in our society are at the intersections of disciplines. And so it's taking down these disciplinary borders and bringing things together. So both complexity and consilience, the Santa Fe Institute very much encapsulates both of those.
I think that was a really interesting end to a fascinating conversation about you and your book, Expectations Investing. Where can our audience follow you and all your work?
The probably best way to go is at my Twitter handle, which is at MJ_Mauboussin, MAUBOUSSIN. And usually almost everything I do, I eventually will find its way on the Twitter handle.
Great. Thank you so much, Michael.
Thank you for listening to Investing by the Books, a podcast by Redeye. You can follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve the podcast, we really appreciate your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. For the sound engineering of this podcast, we thank Gustav Tesch, and for this editing, Carl Bergholtz. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.